Hey y'all, AC here, and today we're going to be talking about bonds. Yes, the super generic bond. It's a little bit different than our normal investment advice, which revolves around stocks, equities, real estate, and crypto. But I think we got to talk about it. It's kind of a crazy environment we're in right now. So hear me out. I know it's atypical, but the real estate market is crashing, the equity market is crashing, crypto's doing its own thing, and inflation is crushing me. So we got to find somewhere to park our money, right? So that's where bonds come. Right now, the federal government is guaranteeing a 9.62% return on your money. That's right, you heard me. 9.62% guaranteed return for the next 6 months. All right, to put that into a little bit of perspective for you, let's compare it to the index funds. So the S&P 500 is the most common index fund out there, and on average, the SPY will return 7 to 10% per year. But you have to remember, this is not guaranteed by any means. The average is 7 to 10% per year. On any given year, you could have minus 15% and be down on your equity curve. The beauty of the bond market is that it's guaranteed, which means that your money will continue to grow every year. So what exactly is a bond? So pretty much a bond is just a way for a federal government or a corporation to lend money. So anytime you need to borrow money, you go to the bank and you take out a mortgage or a loan for education, for a house, for whatever. And a bond is pretty much the same. I-bonds are a special type of bond issued by the federal government because they're linked to inflation. And so with the current inflationary environment, we have these crazy interest rates. So if this sounds like a great deal to you, let's learn a little bit more about the specifics and let me tell you why an I-bond should be a part of your portfolio. Let's get into it. Number one, right now the interest rate is set at 9.62%. Now, November 1st, they are going to set a new rate, but the beauty is if you lock in this rate on before October 31st, that 9.62% actually carries for 6 months before the new rate kicks in. And so if the new rate is lower than 9.62%, you're still going to get that 9.62% even if you invest in October 30th. Number two, so the limit per person is $10,000. Now that is per calendar year, so if in the year of 2022 you wanted to buy $10,000 and then in 2023 you wanted to buy another $10,000, you could do that. Number three, they're only purchasable directly from the federal government. There's actually a website called treasurydirect.gov and you have to make an account there and buy directly there. You cannot buy I-bonds in retirement accounts, so Roth IRAs, 401ks, traditional IRAs. Unfortunately, you cannot buy I-bonds in these accounts. You have to buy them in a traditional brokerage, which means that there are going to be taxes, but we'll get into that a little bit. So they won't be available on traditional marketplaces like Robinhood, Webull, Interactive Brokers, Thinkorswim, Tastyworks. It will not be available there. You can only buy them on treasurydirect.gov. Number four, also this is really important. Make sure that the money you set aside into these I-bonds, you're not going to need it for at least 1 year. There is a 1-year holding period where you cannot access your money. So make sure that the money that you're putting in these I-bonds, you don't need it for bills, for mortgage payments, for school, etc. And if you wanted to withdraw your money before 5 years, there actually is a small penalty. The penalty is 3 months interest. So let's say that 2 years from now, the interest rate is now 4%. Those last 3 interest payments of 4%, you're gonna have to give back to the government as a penalty for withdrawing early. And if you choose to withdraw after 5 years, there actually is no penalty. The entire length of the bond is up to 30 years, but between years 6 and 30, you don't have to pay an extra penalty to withdraw early. Number five, so how exactly do bonds make money? It's quite simple actually. On the first of every month, you're gonna get paid an interest payment to your account. And then every 6 months, all of those interest payments get added to your principal, and that becomes your new principal. So every 6 months, you start to get a larger and larger interest payment because your new principal starts to go up and up and up. All right, so those are the basic facts. Now let's compare some of the pros and cons. So what are the pros of I-bonds? So first of all, whenever you make an investment, you have to think about the risk and the reward. Typically, in a normal investment, if there's low risk, there's higher reward. Now, in this case, a 9.67% is a pretty substantial return, but the risk is pretty minimal. So the actual risk in losing your money or your principal investment is 0. Because the interest rate can never fall below 0%, your money will actually never lose money or start to go down in value. The real risk actually is that adjustable interest rate. So right now that adjustable interest rate is set at 9.62%. Let's just say that somehow inflation is tamed in 6 months. Let's say the interest rate goes down to 4%. Well, after that, for the next 6 months, your new interest payments may be 4%, which is less than the 9.62% right now. But regardless, your interest payments will never fall below 0%. And in reality, inflation is really hard to tame once it gets to these numbers. And so right now, the Fed is spiking the interest rate in an attempt to bring down the inflation rate. Now, they may do this successfully in the next 6 months, or it might take 12 months or a year or 2 years. And in the meantime, you're going to be getting these guaranteed returns with these I bonds. And just remember that even if there's a deflationary environment or the interest rate becomes negative, the lowest the interest rate can go to is 0%. So in that case, you won't be getting paid any money, but you also won't be losing any money. So there's actually zero risk of losing your money. There's just a risk of not making as much money as you would in other investment portfolios, such as an equity fund or the stock market. And actually, taxes are one of the pros. So remember how we mentioned you can't invest in retirement accounts and you have to pay taxes? The good news is that you're only going to be paying the federal income tax. So you don't have to pay state tax, you don't have to pay local tax, you don't have to pay Social Security, all of those other taxes. You're only paying the federal income tax rate. All right, so those are the pros. Now what about some of the cons? Now, we already mentioned the first one, which is the holding period. You must hold bonds in your account for at least 1 year. So don't expect to be able to withdraw that money for 1 year. So just pretend that it's not accessible for 1 year. So just make sure that it's not a part of your rainy day fund or mortgage payments or anything else that you might need in the short term. Make sure you earmark it for long-term investing. And remember, if you withdraw it before 5 years, you do have to pay a penalty, which is equivalent to 3 months interest payments at the tail end. So for example, if the interest rate, let's say on the I bond was 4% 3 years from now, when you do make that withdrawal, you're going to have to give up those last 3 interest payments of 3%. And remember, if you hold it for 5 years, there's no penalty at all. And let's talk about the elephant in the room, that variable rate. So right now, the variable rate is in our favor because it's set at 9.62%. But let's say in a year now or 2 years from now, the rate is down to 3%. But at that point, that's a pretty meager return on an investment of 3% a year, especially when you can be putting it in other places such as an index fund, which will on average return 7 to 10%. So right now this is a pro, but just remember that over time this variable interest rate might become low enough to the point where you want to withdraw a little bit earlier. And another way to think about it is you're not necessarily beating inflation, you're just keeping up with inflation. And so if inflation is at 10% a year and you're getting paid 10%, you're not necessarily making money because the cost of goods are going up by 10%, but your money's not devaluing because you're keeping up with that rate. So the way I like to think about it, these I bonds are pretty much a hedge against inflation. If inflation continues to run rampant for the next 5 years, that's terrible in all other aspects of our lives, but at least these I bonds will be giving us a pretty decent return. All right, and finally to our last con, and this is probably the biggest one. So remember that website I told you about, treasurydirect.gov? Well, I wasn't completely honest with you. That website is kind of trash. I'm sorry to say it, but it's just not very good. The website is hard to navigate, it's kind of clunky, and the technical support is almost non-existent. So just be careful when you're making an account. I would say that the number one thing you need to remember is they're going to ask you to identify an image and a passcode. Make sure you don't forget those two things. I know people who have forgotten those things. It takes a couple of hours to recover, which isn't the end of the world, but it can be quite frustrating when you're trying to access your account. So when you sign up, just make sure that information is actually stored in another safe place as well, so you don't forget it or lose access to your account. So that's it. That's pretty much everything you need to know about I bonds. Buy them before October 31st. You have to buy them on treasurydirect.gov. You can buy up to $10,000 worth of bonds. You have to leave them in for at least 1 year, so don't expect to withdraw them before a year. If you do withdraw them before 5 years, expect to pay a small penalty. And that's pretty much it. I hope this was helpful, and hopefully you add some I bonds to your investment portfolio. See you next time. And by the way, if some of these investing terms are a little bit unfamiliar, I'm going to be making a video about the 5 most common things that beginner investors should know, so stay tuned.